Welcome to another Market Insight, where we sift through the noise to get to the signal to give you actionable advice so you can make informed decisions. Today's going to be fairly technical, but I also think it's going to be a quick one. Why don't we jump right into it? What are the technicals saying about the market?
Yeah, so I've divided the slide into about 3 or 4 different sections, and I think it kind of tells the same story, which is this market wants to move higher. So if we look back to the end of July through August, we have that green trend line going straight up. And then we kind of stay flat for a little bit. And then we enter that first circle. That's the Jackson Hole speech. Right. We've talked about it a lot. The only thing new that's come out about that recently is the Wall Street Journal released a piece saying that Powell had a speech. He got rid of it because he wanted to tighten financial conditions.
I think he was nervous. He's like, I'm just going to go off the cuff.
So he just went for a quick 8-minute speech to try to, tighten financial conditions, bring stocks down. That worked for a couple weeks, and we see the green line coming right back up early September. And we actually see that, they would call it a shooting star, the little green bar up was actually back to where we were during that speech. Mm-hmm. So it was like the market said, I don't necessarily believe you with this tightening. I think inflation's going to come down. And then we got CPI the next day. And that's the second circle that I've drawn. Another 3% down day off a CPI report that showed some categories were coming down, but core inflation was still at 0.6 on the month. They want to see that at 0.3 or below. Definitely want to be below, but 0.3 would really be the peak you'd want to see there. And it was just too high. So what I see on the charts is market wants to move higher once we can get past tightening and inflation, and they keep trying to think that it's now the time, but maybe that inflation is going to linger a little bit longer.
Yeah, and it's probably not so much as it is inflation as the market understanding where the Fed is going to move interest rates. Because of inflation's going to be high, the Fed's going to continue to do its tightening, which is, I think, one of the reasons Powell is throwing away his speeches on this. But I think one of the things we have to understand is how does the Fed control inflation with interest rates? And we really have gone from what used to be known as a scarce model to now an abundant model. And what is all that? What does that mean? Well, it used to be that the Fed, with their open market movements, would go out and they would buy or sell treasuries and try to keep interest rates at a certain spot. And that would basically set the floor for where interest rates would be for banks loaning to each other. And it would typically be banks loaning to one another. There was the ability to go to what is known as the discount window and then ask the Federal Reserve for a loan to meet your cash needs if you were a bank. But basically the Fed, for the most part, just provided liquidity, not cash. And what I mean liquidity is that you could sell the bonds and know what price you would get, so you could basically bank on the cash that you would get if you needed to sell those bonds and turn them into cash. That was kind of the way the Fed really managed the money supply. But what happened is there was more scarcity around the cash in the system. Because if interest rates were moving up, the way banks were competing, they were competing from deposits from savers. And that means savers would increase the amount of savings that they would have because now there's a more compelling interest rate. Mm-hmm. And I put the S in the old GDP calculation, C plus I plus G, minus savings, minus taxes, plus net exports. And if you look up the equation, savings is never there. There's this concept of the paradox of thrift. The reason it's not in the formula, though, is because savings are always loaned out by the bank. So it's just a deposit that you have at the bank. They then make the loanable funds. But if you are increasing your savings because interest rate is going up, that means you're consuming less. And that lower consumption would slow inflation because there's less demand for goods. Mm-hmm. Also, there's a higher hurdle rate for investments. If you can borrow at 2% and earn 3 to 4% on an investment, you would make that. But if you can borrow at 6 or 7% and only get 4 or 5, well, those opportunities wouldn't be there. And it really created scarcity. It's not that the Fed wasn't providing or expanding the monetary policy, but it was really allocating this difference between consumption, investment, and savings within the economy. Well,
and this was the pre-2008 model,
pre-2000.
Right? And if you have a chart, you'd see scarce reserves. Reserves were really, really small. This was before they expanded them by about 50, 60 times following 2008.
And we get into what's known as the abundant model. And what had happened is prior to this, there was a stigma to go to the discount window. It's not that you couldn't go to it, and it's certainly not that there wasn't a profit motivation. It's just if you were going to the discount window, a lot of regulators assumed that other banks weren't loaning you money and they needed to audit your books. So that kind of put a little bit of a break of going to the discount window. 2008, the Fed said there's no stigma in this, it's not going to be audited. Well, then that caused the banks to go to the discount window and not necessarily compete for deposits amongst the economy. That meant consumption could stay high, investments could stay high, and the Fed actually got their interest rate down to zero. You could borrow at zero. That created a lot of new money coming into the system. That created that abundant model that we're talking about. And really what this did is basically expanded the money supply significantly. And ultimately, it's the money expansion that causes inflation, not the interest rates. We could go to Venezuela that has 58%, 59% interest rates at the moment. That's not stopping their 110% inflation. So then with this new model, how is the Fed actually going to slow inflation? Well, we don't have a lot of history with this model, so the easy answer is we don't know, but we can kind of run through some hypotheticals. And what you can do is you can deposit, and since 2008 a lot of banks have done this, funds with the Federal Reserve and get paid by the Federal Reserve to hold your deposits. This did not happen prior to 2008. And the Fed will use what they're paying on the reserves that you could park at the Federal Reserve as a way to try to slow the amount of loans that are being made out in the economy. Because if you can get paid 50 basis points to the Fed, basically risk-free, why go out there and take risks to get 50 basis points? So then they begin to move that reserve rate up to try to slow the amount of loans being made. But one, the Fed is paying banks to not make loans. Politically, that's probably not the most palatable long term. But also, if you can still make loans at 8%, 9% because inflation's higher, there are plenty of corporations that'll do so, and the banks will just move up the interest rate. So long as you can borrow at a lower rate than inflation, a lot of companies will choose to do so. So I don't think we could really stop inflation until those reserve rates in this model are actually brought up to what inflation rate is. And at 4%, if inflation stays near that 8%,
Yeah.
you're not going to get that.
And you originally said slow inflation, because that really is the goal, right?
Right.
Just to stop the growth of inflation from being too high. Their goal is to just have the growth of inflation be 2%.
Right.
So it's still growing. It would take a significant outright contraction of the money supply with the balance sheet runoff, which we'll talk about later, to really, if potentially, bring inflation way back down.
Right. And the way that can happen is, sure, the Fed could move their reserve rates up to, let's say, 8 or 9%. All of a sudden, banks will not make consumer loans. They will not make investment loans. They'll just park their money at the Federal Reserve. So that means that loan expansion in the economy is going to slow.
Right.
It'll slow into a recession. But it ultimately is probably the recession where a lot of debt that's on there that acts as that proxy for cash. Remember, the Fed is making a market at the front of the curve, meaning they'll buy the debt. Well, if you have to liquidate that debt, that's also contracting the money supply. And it's the recession that would probably, what I see as the more likely scenario of stopping inflation, not interest rates at 4 or 5%.
That's what I was going to say. Your example of bringing that IORB up to 8%, that's going to stop inflation. But no one's talking about bringing it up to 8%, right? They're talking about bringing it up to 4 or 5, and that's 4 to 4.5%. And that's the uncertainty is, can you actually stop inflation at that low of a rate?
Right. So then when we're looking at the money supply, the question is that contracting? And the answer is, well, it has been, but there's now been a slight uptick. And this is while the Federal Reserve is beginning to roll off their balance sheet. Now, it's very confusing. There's a lot of moving parts here,
Yeah.
which makes it very complex, even for the Fed. It's like it's hard to get this right. But we're paying attention to the money supply because it's the money supply that ultimately will start to slow that inflation. And it's slower growth. This will, over time, slow that inflation if we stay around here.
And as always, we're looking at that green line, which has ticked up twice over the last 2 weeks.
Right.
They're starting to roll off their bonds and their mortgage-backed securities. They did actually purchase about $5 billion in mortgage-backed securities last week. That may be partially why we went up. They made those commitments early on in the year. So the market knew they were going to be making those purchases. That's the last one. Now it's all runoff from here. So we probably will see a little bit more contraction. When we look at the Fed balance sheet, we ran it all the way up to almost 9 trillion. And we see on the far right there, that's the forecast of where the balance sheet runoff is going to go. This is the outright shrinking of the money supply. They're going to let about 90 billion per month, 95 billion per month, so a little over 1.1 trillion per year roll off. That's that steady forecast of just keep going down. This is the uncertainty of, is this going to impact inflation? Will it bring it down slowly over time? Or will they have to actually increase the pace that they're doing this and actually sell bonds instead of just letting them mature?
I feel comfortable going out on a limb to say we won't see it roll off this much. They will begin to have to stabilize, because if they were to shrink this, the money supply would contract and the economy would then look weak.
Yeah.
And we would see that inflation go away because the demand for goods and loanable funds is shrinking. So I don't see this forecast as being accurate.
No, and right now it is they have to talk tough, because the reality is if they go at this pace, they will bring down inflation over time. But it's going to take longer than expected and longer than what is really politically that they're able to do.
So that's inflation and what we're seeing, and we know that the Fed is talking today, so we'll get a lot of information about that and parse through it over the evening. What about earnings?
So we'll be getting earnings over about the next month. So I just wanted to do a quick, expectation of where we think where the market thinks Q3 earnings are going and what they've seen so far. So the top panel here is pre-announcements. So you announce something positive or negative, something that's very different from what you were expecting. And if we look at Q3 and you take a negative to positive ratio, we've had about 1.2 negative pre-announcements to positive. Now it's still early. We still have time to start building up more negative pre-announcements, and we probably will. Q2 22, so last quarter had 77 out of the 500 companies pre-announce and say, hey, we're not gonna hit our numbers. Right now it's at 53, so not terrible, but it is higher than the average. It's much higher than last year at 41. So the market isn't expecting great earnings. And if we look at the actual growth rate, so that's the bottom right for the S&P 500 broken out by sector, only expecting a 5% growth in earnings. That includes energy, which has over 120% growth expectation. If you get energy out of there, market's expecting about a 2% decline in the S&P 500 X energy. So the market's done a lot of work to expect earnings to come down. We're at PE ratios that are right in the 25-year average at 16.5. So market's not expecting great earnings, but the market's also not fully pricing in a recession as well. So I do think there is a little bit more downside from here. Once we can clear out inflation, like I said earlier on the charts, I do think we're going to start seeing things move higher.
Now we're making changes within the portfolio almost every week. And nothing major week to week, but we've been slowly building cash, because though the PE ratio is not necessarily seeing a recession, our technical indicators are showing that there's to have some caution here. And then one of the ways that it works is that we'll get a sell signal, meaning that an asset isn't doing as well as its benchmark, and now all of a sudden it's a sell, but then we look for a re-entry. And one, it has to be doing better than the asset, which is usually 50% of the market is usually doing better than its benchmark. But if the benchmark is the T-bill, it's not always the case that it's doing better than cash at the moment. And we have most of our securities are not doing as well as cash when we, so we're not getting a lot of the buy signal that we can then redeploy. So we've been slowly building cash as we're getting sell signals in the portfolio. Any comments that you're seeing that?
That's really just it. Building treasury, short-term treasury, cash almost equivalent in 5 to 7% of the portfolio. Dividend payers, quality names, that's where you want to be right now.
Right, and we're definitely seeing that, especially in Signal, where we can make a lot more changes. Seen an increase in the amount of energy exposure. We have some commodities exposure, mainly through the producers. It's been very volatile. It's been up and down. So the volatility really, we want to be careful whenever we're going in there, because it may be near the top on a relative strength basis, but a couple of weeks from now it's back down near the bottom. So very volatile, so we're trying to find things that are a little bit more stable through that. We really appreciate you tuning in. If you like today's quick call, go ahead and hit that like button. If you haven't subscribed yet, hit that subscribe button, and always hit that arrow to share with your friends. We really appreciate it, and we'll see you in a couple of weeks.